Stocks have been one of the most powerful tools for building wealth over the last 100 years. So, why is there so much confusion around them? Because maybe it feels like the system is rigged, because you can't control it, because maybe the one time you tried, it dropped and you pulled your money out instead of holding your position. Today, I'm breaking it down: how the stock market actually works, what kind of returns you can expect, what to avoid if you want to build real wealth, and what I personally invest in, even with millions of dollars in real estate. This is the Women Growing Wealth Podcast, and I'm Tamar Hermes. We're talking all things stocks today. Let's dive in. One of the questions I frequently get is, how does the stock market actually work? When you invest in the stock market, you're investing in ownership. You're becoming a business partner with companies that are already running, already profitable, already building wealth for their shareholder companies. That's what a stock is. It's a slice of a company. You don't have to guess what to buy. Most investors, yes, even the ultra high net worth ones, don't stock pick. They invest in stocks through index funds. Think of an index fund like a basket. Instead of betting on one apple, you're betting on a whole orchard. If you want to own a slice of the 500 biggest United States companies, you can invest in stocks through Vanguard, VOO, or SPY. You're diversified. You don't have to watch the market daily. You don't need to be a genius. You just need to stay in the game. Let's talk about what kind of returns you can expect from the stock market. The S&P 500 average over the last 10 years returned around 11 to 12% annualized. This includes appreciation and dividends. If you'd invested $100,000 in the S&P 500 index fund in 2015 and held it through 2025, you'd have around $280,000 today. Let's compare that to investing in a single stock like Apple. If you'd invested over the last 10 years in Apple, that same dollar amount of 100,000 would have returned 26 to 30% annualized return. That would have been over $1 million. This is the power of investing. Granted, when you invest in a single stock, there's a lot more volatility. Women hesitate in the stock market for generally three reasons. The first one is control. Real estate can feel tangible. Business feels controllable, but stocks, they're out of your hand. And that triggers some people, especially for smart, successful women who like to make strategic decisions. The second is that we worry. We see the market go down. We've tried it before, we've panicked, and we've sold at the wrong time. So let's say you've lost money, but it's only because you sold. Maybe your parents told you they lost everything in the stock market during a big crash because they had to sell it when the stocks were down. If you can hold over time, that wouldn't happen. The third reason, sometimes women do not want to invest in the stock market due to overwhelm. It feels too complex, and complexity is the gate, not the necessity. You don't need to know every single stock. You just need to have a framework. What's critical is to invest in companies that you like, even maybe ones that you use. Returns are likely as long as you don't interrupt the process. The market will drop, and it's not a bug, it's a feature. In 2008, the market dropped over 50%. In 2020, the market dropped 34% in a matter of weeks. And every time, it came back even stronger. The best time to make profits is to enter the market during those dips. Some people set up dollar cost averaging, putting a bit of money into the market on a monthly schedule. This also is an effective way to grow your wealth. Statistically, the best returns come when you set it and forget it. Think long-term, 10 to 15 years, and you won't be sorry. If you don't want my advice, listen to Warren Buffett. If you aren't willing to invest in stocks for at least 10 years, don't even think about owning them for 10 minutes. So why do people panic? because they're checking their accounts daily because no one taught them that the market is emotional, but you don't have to be. Let's talk about the cost of trying to time the market. Missing just of the 10 best days in the market over the last 20 years can cut half of your returns. Markets move fast, and when they rebound, it often happens in short, smart bursts. If you miss that window, you can miss the upside. Maybe you're thinking, I'm in the market, I have an advisor. My company gave me a mutual fund. Yes, but do you know what you're invested in? Do you know your cost basis? Do you know the kinds of returns you're making? If your financial advisor is doing a great job for you, set it and forget it. They're paid to serve and support you, but you want to make sure that you're checking. If you've been underwhelmed with your returns, or you want to just start getting into controlling more of your portfolio, you can start to set up your own funds. If you're not set up yet, you may want to just start with the basics we've discussed so far and keep your fees low. Let's say you invest $100,000 for 20 years. It could grow to $208,000, but with a 1% fee, while I wouldn't not invest with a financial advisor if you're really happy with your returns, just know that the 1% fee average that they charge does add up over time. That's something you just want to make sure that you're getting the type of returns you want. Because if you're just going to put your money into an S&P 500 or an Apple stock, you generally won't need an advisor if you don't need any fluctuations and you have the discipline to hold it. The most important thing to do is to make sure you make a conscious decision and not an assumption. You can even break down your investments with some being managed by an advisor and some being managed on your own. To get started opening a brokerage account, you can just go to one of the large companies like Vanguard, Fidelity, or Schwab. It takes only 10 minutes. Again, if you're buying just the big funds and you know exactly what you want, you may not need management. You'll often hear people talk about mutual funds, ETFs, and individual stocks like they're the same. Let me tell you about the differences. Individual stocks mean you're buying one company, one bet, one outcome. Mutual funds are bundles managed by professionals, and they do have higher fees. ETFs are like mutual funds, but they're traded like stocks, so they have lower fees. They track indexes like the S&P 500. Start with a broad portfolio, S&P 500, Vanguard Total World Fund. These will have the largest 500 companies all in a basket, so you don't have to think about it. Another question I get a lot is about bonds. Bonds are loans to governments or companies. They pay interest and are stable, but often give you lower returns. While they're more attractive, they won't beat the stock market in the long term. Many financial advisors like to offer them together so that maybe you have 40% in bonds and 60% in the stock market. If you need your money in the next 2 to 3 years, you want to consider what you invest in the stock market. In my investing group, we also share other opportunities that offer short-term strategies targeting 10% annualized returns that are not part of the stock market. Stocks are great for retirement, legacy, and buying freedom. Set it and forget it. If you automate your investments, even putting $500 a month, which is $6,000 a year over 10 years at 9% would be $150,000. Most important is that you don't pull all your money out. Personally, I don't put all my money in stocks or all in real estate. Wealth isn't about extremes for me. It's about allocations. I use real estate for cash flow, and tax efficiency, stocks for growth and compounding. Together with tax strategies and 40 plus other investments is how I strategize building wealth. I don't check my stocks daily. I don't trade. I invest and let time do what it does. Here's the hard truth. If you think the market's too volatile to invest, you need to take a hard look at your cash. If you leave $100,000 in cash for 10 years at 3% inflation, it shrinks to $73,742. That's a loss of $26,000 by doing nothing. Inflation erodes your wealth every single year. The market may drop short term, but inflation will steal your future slowly and silently. If you've been sitting on cash, waiting for the right time to invest, the best time to plant a tree was 20 years ago. Remember, and the second best time is right now. You don't need to know everything. You need to take action on the things that work. The market doesn't reward perfection. It rewards participation, patience, and time. This is how women build wealth, not by out hustling everyone, but by putting money to work so that they don't have to. If you want help figuring out your next move, start by calculating your enough number, the amount you need to be financially free. Download my calculator at getyourenoughnumber.com right now, and it only takes a few moments to plug all your numbers in and see where you stand. And if you like this episode, subscribe, review, and share it with a woman you love. This is the Women Growing Wealth Podcast. Thanks for listening.